We're going to go through an agenda. The agenda we're going to use, we're going to just talk quickly about the risks that we want to address during this particular talk. We're going to talk about the power of earlier planning, annual insurance optimization, and then a systematic marketing approach, a crop marketing approach. And when you put all those things together, it can provide a great framework to be able to make decisions about risk through the crop marketing year. All right, next slide. All right. Well, I apologize. All right, here we go. So these are two regulated industries when we deal with insurance and when we deal with brokerage. And so I do need to go through the risk disclaimers. These are important. So FBN brokerage services are offered by FBN-BR LLC. The commodity trading in futures, hedging, speculating, it all involves substantial risk of loss and may not be suitable for all investors. So past performance is not necessarily indicative of future results. All information, publications, reports, including specific material used and distributed by FBN-BR shall be construed as solicitation. FBN-BR does not distribute research reports, employ research analysts, or maintain research department as defined by CFTC Rule 171. And then in regards to our disclaimer, these views and opinions are solely those of the author as of the date of publication and are subject to change at the time due to market conditions, economic conditions. Will not be updated or supplemented after this date hereof, may not necessarily come to pass. The views and opinions expressed here do not reflect those of all personnel of FBN-BR LLC or the views of Farmers Business Network. And then finally, any charts and graphs provided are for illustrative purposes only. Any performance quoted represented past performance does not guarantee future results. Commodity trading, including futures hedging and speculating, involves substantial risk of loss and is not suitable for all investors. So today, I am excited because this is the first time we're really doing a presentation that involves all three of our business units: the finance side, the insurance side, and the crop marketing and brokerage side. And we've got great people here to be able to talk about it. Eric Sorensen has 25 years of crop insurance experience, both on the company side and on the agency side. Josh McClure has 15 years consulting for market advisory and brokerage. And then TJ Wilson is a farmer out of northeastern Kansas and also nearly 20 years of ag lending experience and has dealt with many farms all across the U.S. So we got a lot of experience up here, and what I'd like to make sure is that if we can get to the end on time is that we open it up for questions and we can have a little bit of a back and forth to close off this session. So one thing that I want you to do is think about this presentation in terms of a framework that you can then evaluate what you've done in the past or your current marketing plan. So there's some principles here, there's some concepts, and I'd invite you to see how do these concepts and principles apply to what you're currently doing. And then keep in mind that if you want to kind of have a bigger discussion with TJ's team, Eric's team, or crop marketing, we would be happy to spend a little bit more time and dig into your specific operation. So without further ado, I want to hand it over to TJ Wilson to talk about the finance aspect of risk management.
Thanks, Cody. Can everybody hear me okay? Good to go. All right, so from the finance aspect, what I'm really going to talk about today is just planning. Obviously we've got a number of experts up here. They all really going to focus on their niche that they can help reduce that risk for your operation. But how do you get to that point to make that decision? And it's by starting with your plan for the next year. So we're going to go through a few financial considerations that everybody should be looking at when they're looking at their operation for the upcoming year. Obviously, December. We're looking at your year-end planning and everything going on right now. But first things first, what are you going to do next year? Row crop operation, what are you going to plant? What's your rotation going to look like? What kind of crops are you going to plant? Where are you going to plant them? How many acres of what variety? So really getting into that budget and planning and your break-even analysis, step one, figuring out what you're going to do for the next year. It's important to do that early. As all of you know, you're in the combine potentially, and who's knocking on your combine door wanting to ride with you? It's the seed guy. So they're wanting to sell you seed, wanting to lock in fertilizer earlier and earlier every year. So understanding what those costs are going to be and making that plan for the next year is going to be imperative, because they're going to come knocking on your door sooner and sooner all the time, because they want to lock in their supplies as well. So as we talked about, early planning allows for a lot of flexibility. So early planning is going to allow you to figure out what your purchases are going to be, plan how much you're going to need, and work with your suppliers to be able to get those in place and take possession of those and lock in those prices sooner. It's also going to work with being able to set up your risk management plans, which these guys will talk about later. So risk management plans are going to be important. It's all year long. I'll go into a little more detail on some of those particulars on that risk management plan here in a bit, but that's going to be imperative for you to be looking at for the coming year as well. And obviously, working capital. We'll talk about this, but addressing your working capital needs is an all-year thing when it comes to every farming operation, figuring out how much cash you have and how much cash you're going to need to operate on the coming year. There we go. As we talked about early, be proactive though. We definitely, with your operating loans, everybody typically uses an operating loan. We know how much money it takes to operate on a year, and the statement or the flow of your cash throughout the year and the timing of those cash flows is tougher and tougher all the time. As we talked about, everybody's going to want their money earlier, but you're probably not going to sell your crop until later in the year, because you're trying to pick up that spread and that basis, and you're going to work with your risk management advisor to figure out the best plan, and the timing may not always work out. So when you're looking at your operating loan, be proactive, get after it early. Try to lock in the rate if you can. Look at what makes the most sense for your operation and how much risk appetite you're willing to take. So part of that is figuring out the size of the line you need. You don't want to get too big a line. Obviously, you don't want to borrow any more than you need to operate, but you also want to make sure you have plenty of room within your working capital needs. So make sure your line is big enough to allow for you to make those flexible decisions. Buy early, sell your crop later, whatever you need to do that year. You want to make sure you have that flexibility. Rates and terms. Rates are not a fun topic right now for anybody, given where things have gone over the last 6 to 9 months. But look at this. Is your rate fixed? How long is it fixed? Is it variable? When does it adjust? Figure out what those parameters look like. The other key factor in this is, when does it come due? Make sure that when that line comes due, you're in a position that you're going to have cash flow or sales to be able to pay that, reduce that line down. That's going to be important for any operation. Last thing you want to do is be in a situation with your potential lender that loan's going to mature and you're not going to have the timing right there. You're not going to have the cash flow needs. Last thing on the list here is just revolving or non-revolving. You're seeing a lot more non-revolving lines out there. So you can only advance on that once. That doesn't always work with all operations, crop year by crop year. So having that ability to have a revolving line is important as well, but know the difference. Know what you have available to you, know how much you can borrow at any given time. And next on the list is just the input supply. We talked about this. Everybody's coming out earlier. Why are they coming out earlier? Because the suppliers want to lock in their supply and they want to lock in their sales for the year. Typically, when they're doing that, they're giving you discounts to be able to do that. They're giving you breaks on pricing to lock in supply early. So if you're in a situation and you're planning ahead and you're being proactive on that, you're going to get better deals. If you have the working capital in place, you're going to get a better deal on your operation as long as you plan ahead and know what you're going to be doing for the coming year. Lock in those prices early. Lock in supply early if you can. Take possession. As we saw last year, hopefully not going to see it this year, but last year we saw where you just couldn't get your hands on a lot of that product. So if you can take possession of it early, do that. Make sure you can get it on your premise and be able to use it when you need it. Next here. All right. Next on the list is just capital and risk management. We talked about working capital a little bit. I want to go into more depth on that. As we all know, you always hear cash is king. That's imperative for anybody. But what that allows you to do is have a lot more flexibility in your operation. But Do you have to have cash, or do you just need to have room in your operating line, or room in your working capital position? That's more important, probably. Knowing what your room is, knowing how much flexibility you have in your working capital to make your decisions, that's going to play a key role in your operation and your planning for the next year. So part of that is doing the budget that we talked about, knowing what your break-even analysis is, and knowing what your timing of cash flows is going to be for the year. Do you have payments coming in at a certain time? Do you know you're going to pay your suppliers? Do you have rents due at a certain time? When do you typically sell your crop? Knowing what that timing is going to allow you to do a lot of the planning that you need to do for the year, especially when it comes to your risk management plan, which this group will talk about in a little bit. Knowing the timing of those cash flows, knowing what you need for working capital is going to allow you to evaluate and set a strategic risk management plan to work within those needs. That's going to definitely allow you to set what type of risk management plan you're going to need to. If you don't have a ton of working capital room, maybe you're going to change your strategy. Maybe you don't have as much room to absorb margin calls if they come. So you're going to be more of a cash seller or a future seller at that point in time. So know what you're doing with your operation, know how much working capital room you have, know how much flexibility you have. It's going to make it easier to make a lot more decisions. So as we talk about that, how are you going to protect that investment? We talked about the risk management strategy. Crop insurance, crop marketing, advisory services are going to play a key role in that operation. They're second to none. I think it's imperative for every operation to have an advisor and have a crop insurance agent that they can talk through as a trusted advisor and figure out the right strategy for their operation. With that, I think I'm handing it over to Eric. If I can change slides here.
Thanks, TJ. Cody did such a nice job with disclaimers. I'd love to hand this off to him, but we'll go ahead and go through this here. So, thank you, TJ. All right, so this is a required disclaimer, so bear with me here. We're an equal opportunity provider. The purpose of the following materials is to promote awareness of risk management concepts and to highlight risk management products, features, benefits, and availability. The presentation doesn't provide full details of policy provisions or approved procedures. Producers should consult with a local agent for specific details and program requirements. Thank you for bearing with me on that. Okay, we'll just go through, and this is going to be really high level. So those of you that are expecting like 2 hours of crop insurance excitement, wait for the next hour. Only kidding. So buy now, pay later terms. And this is a lot of stuff. Most of you in the room are buying crop insurance and have bought crop insurance for years. So you're like, yeah, that's not new news. But sometimes we don't think of it that way. It is pretty easy terms, especially the last 3 years. RMA has extended that interest deferral deadline, pushing it clear out to the end of November, which is kind of nice. No interest until months later because of that. It is a tax deductible item like any expense. Until it becomes income. So it's kind of a unique financial vehicle that way. Federal premium support, of course, it's been around for decades now, greatly reduces the cost versus what you would normally expect to pay. And then a lot of times we get feedback from producers saying, well, your agency has the same plans, same products, same price and everything that I have currently, right? So how could you be any different? Without going into that too deeply, it's really a tool, and it's kind of nice in a way because there's so many things that you might want to negotiate or have to negotiate and spend time doing that and all the research involved. At least you don't have to negotiate those prices. You just have to look at the service you're receiving and the consultation behind it. So like we say here, the expertise, the service, the insights, the resources, ease of doing business, and ultimately the results year in and year out is what makes a difference. Some things to think about when it comes to making that crop insurance decision. Again, just keeping it really high level here. How many opportunities do you have to make a decision on crop insurance each year? Is it only the end of February? Is it only March 15th? In some cases, you might have additional opportunities that maybe you haven't thought of. So in the next session, next hour, we'll talk about margin protection a little bit. And even though the ship has sailed on that deadline, which was September 30th, that is an alternative deadline to buy crop insurance coverage. There are some private products out there that also offer additional times to lock in price, for instance, on your crop insurance policy. So it's good to make sure that you talk to your agent and understand those things. So how do you make the decision itself, right? There's a lot of things to factor in there. TJ touched on a lot of them. You need to know your cost, obviously. need to know what your break-even point is. In the next hour, we'll talk a little bit more about some tools to kind of help you see that and kind of work with you on that. Certainly, it's good to start with the back of the envelope number, but it can even go deeper than that. And then focusing on farm profitability versus cost. There's a lot of differences of opinion, different schools of thought out there when it comes to crop insurance. Some people say, you know what, I want to spend as little as possible and don't take much into consideration, where your safety net actually kicks in. And then, sometimes you could actually spend too much on crop insurance. There's areas of the country where, like in the I-states, for instance, 80 and 85% levels are very common. Why is that? It's because it's a lot more affordable there for those crops in those areas. Then you come to some other areas of the country where it's not affordable. It's not a good return on your insurance dollar to spend above, let's say, 70 or 75% level. So all that stuff has to be weighed year in and year out. And again, on the private product discussion, sometimes you can kind of punt for a while on that. But when it comes to a multi-peril type coverage or an increased price, projected price on your multi-peril coverage, there's been opportunities with some companies to lock that price in since the 1st of July for 23. And just wrapping up here on insurance, this is just a quick look of some of the most recent tools that we've developed at FBN. We really believe in helping empower our farmer member customers with making data-driven decisions as opposed to emotional decisions or just decisions that you've always made maybe for the last 20 years and aren't quite sure why. So on the left, you'll see a comparative analysis tool that was developed for ARC County development or ARC County evaluation. It'll just show historical payouts for your crop and county. We have the data to run this analysis for any crop, any county, for all years of the ARC County program, and then chart that out on the SCO, same payouts for SCO, as well as the ECO product. So SCO is that band of coverage from 86% of county expected yield down to meet your base coverage. So if you had an RP 70, it would cover that 16% gap on a county revenue basis. And then the ECO is kind of SCO's cousin, where it works the same way, but it just covers a higher band of coverage. So it'll take off from the 86% where SCO ended and then go up to either 90% or 95%. The rainfall optimizer in the middle, that one was just wrapped up a month or two ago. That one's for pasture, rangeland, and forage, what we also refer to as rainfall index policies. So if you're raising hay, if you're raising cattle and you're on some grazing land, you're really dependent on that rainfall to have that crop. And so that's what that policy's for. We also have beekeepers, they call it apiculture, and it uses the same concept to pay when you have a 2-month interval that's too dry. And so the rainfall optimizer basically helps the agent help you make a good, confident decision with what your budget needs are, what intervals are important to cover throughout the growing season. Just come to a quick, solid decision on that. And then on the third, this risk modeling tool is similar to one we'll look at in the next hour. It was developed for margin protection and just allowing you to see many different payment scenarios and just see how margin protection works over a variety of yields and prices. So, Josh? Back to Cody?
Yeah.
Thank you.
All right, can you hear me? All right, so when we talk about crop marketing and hedging, if we're going to do this part right, we have to have already done the first two steps right. So planning early, understanding what you're growing, running your break-evens, understanding your working capital availability. We have to do all of that before we can really start making fine-tuned decisions on the crop marketing and hedging side. So these are some of the principles that we think are important in a successful in a successful crop marketing and hedging plan or risk management plan. So the first principle is something that's systematic and repeatable. And that usually means it can be written down. When you write something down, the nice thing about it is that you can have an honest evaluation at the end of the year. You can see if you're tracking appropriately. You can see, clearly if you've gone outside of the bounds. So I think writing something down helps to make something more systematic, and therefore something that you can build on, something that's foundational. So systematic and repeatable is very important. The second is utilizing crop insurance as a marketing tool. It provides a certain level of hedging on both price and, of course, yield. And so making sure that you model that in the same way that you're modeling your cash sales, in the same way that you're modeling your futures and options or potentially OTC, over-the-counter exposure, like accumulator contracts or other contracts that may automatically price and then have. Anyway, so if you are able to model that all together, you can make decisions that really that pinpoint and is efficient for your operation. You can understand how insurance is working for you, and then you can know where you need to go and pinpoint the right combination. That gets to the fourth bullet point, which is choosing the right tools for the situation. Because there's a wide variety of tools in the cash market, futures and options, insurance, including private products or margin protection, making sure that you select the right combination for your farm is important. It'll help you it'll help you stay within marketing plan, and it'll help expose you to what's appropriate for your farm operation. And then finally, separate futures and basis decisions. We'll get to that later, but just when you look at it seasonally, futures seasonally peaks at a different time than new crop basis. So just when you look at it from the fundamental standpoint, you're going to have different timing for seasonal peaking over the last 20 years. And so separating those decisions is important. Making sure that you don't just lock in futures and basis at the same time just because it may be convenient, but making sure you're deliberate about the decision around futures and basis. I'm going to talk quickly about systematic. One of the key parts of what we do is identifying really a holistic metric, a metric that spans across insurance and into the cash market and utilizes futures and options as well. If we can track one metric, then we can set guardrails around that metric. We can keep it simple. We can boil it all down to the common denominator. Finally, spreading out your decisions. It is important to spread out your decisions when it comes to risk management because you're not always going to be right. I mean, how many times do we have a bias and yet the market moves another way? And so it is so important to be systematic about that, to spread out your decisions so that you can capture opportunities when they present themselves, and particularly in times when prices are presenting, when you're running your break even, when it's presenting profitability, being disciplined about spreading out your decisions is important to protect that profitability because market conditions can change, and they can change, obviously, rapidly. And then finally, I think one thing that's very important is evaluate it at the end. So if you've written it down, go back. How many times have we really spent at the end of the year and evaluated all of our decisions? And if we're not spending time sitting down there and thinking about the decisions that we made and why, how can we improve? And I think that's an important thing. We need to make time. We got to be deliberate about making time to understand what went into these decisions, and then how can I improve? What are things that worked? What are things that did not work this year? I'm going to pass it over to Josh McClure at this point. He's going to talk about percent hedge. So when I was talking about a single metric to follow, percent hedged is that metric. And Josh is going to go into a little bit more detail on why we use that, and then also move on to making decisions based on profitability as opposed to price.
Thanks, Cody. So when we're thinking about where our when we're thinking about where our risk is at, how much risk we have laid off, how much grain has been marketed, typically we're going to be thinking about this percent sold, right? How much grain do I actually have sold? However, we know that we're actually doing a whole bunch of other things to manage this risk, primarily crop insurance, right? So whether we get 85% RP or we've got 75% RP or we went with margin protection, what is that actually doing for us on an ongoing basis? Is this something that we just put in the safe like it's a fire insurance policy, or does this actually have operational differences for us in the future? Well, a big problem with that is trying to figure out how they relate, right? Because crop insurance today, right, isn't doing anything. Right? It's not, there's no risk management that it's doing at this price and at this yield. Once we get down to a certain point, it'll be 100% covered, right? That's our guarantee. That's our guaranteed price. It's going to guarantee us that we can't have any more losses. And the only way that we can do that, right, the only way that it can guarantee that is if it's selling away all of our bushels. Well, how do we square that circle? How do we actually bring that into a single understanding of risk? And this is where the percent hedged methodology comes in. So what we've done is we have taken the understanding of options and the percentage-based, the evaluating how much a given option, even if it's out of the money or if it's in the money, is affecting us as farmers and as marketers. And we're applying that to insurance because insurance could be doing nothing. It could be getting us 100% or more covered to the downside, or it could actually be buying us a few bushels. Huh? Crop insurance buying us a few bushels? Well, we're going to go into that just a little bit more in the next hour. But we've got to square that circle, and percent hedged really kind of does that. So when we're talking about decisions based on farm profitability, most of us are taking a look at break-evens. We're thinking about the break-even price, just taking our costs over our yield. Okay, this is actually the level that I need to be sold at above this in order to not be losing money. Or on the yield, right? Given today's prices and today's costs, I can produce down to this amount of bushels and still be positive. But there's a whole lot more than just a break even. Well, how much money are we going to be making today? How much money are we going to be making if prices fall 50 cents and yield falls 5 bushels? What are the effects of my crop insurance, of my marketing, futures and options? How is all this stuff working together? And this is where a matrix of profit and loss actually comes in. So in a matrix of profit and loss, we're going to be testing all of our possible break-evens, but not just break-evens. We're going to be looking at profitability. We're going to be looking at profitability, we're going to be looking at loss, and we're going to be looking at the interplay between these. We're going to focus on the percent hedged, which is our new risk quantification, and finally, we're going to have a sandbox to actually play with potential decisions. Oh, somebody told me that I should be buying puts right now. Oh, you know, somebody told me that I should be getting an additional 20, 25, 30% sold right now. Well, what does that do for me and my operation, given all of the decisions that I've made in the past? Oh. So here we go with the matrix, right? So let's walk through what we're looking at here just a little bit. First of all, I know that there's a ton of numbers here, but most of you guys have seen something that looks kind of like this. So first of all, let's just find our bearings here. Off to the side here, we have our vertical axis. This is our price. So, and when I made this, we were at 605. We're about a dime lower than that right now, but that's our vertical axis. Up across the top here, we have our yield. This is our horizontal axis, and this is looking at a 200 bushel production. So the midpoint is going to be today's profit or loss. And at 605, and at 200 bushels, with a 950 bushel, with a $950 per acre cost, we have $260 of profitability. Everywhere that it's green, we have more than $100 of profit. Everywhere that is yellow, we're near break even. up to $100 of profit, down to $30 of loss. And then everywhere that it's orange or red, orange is a $30 loss down to about $150, and beyond that, where it's bright red, it's more than $150 an acre of loss. Now, this doesn't have any risk management attached to it. So because of that, the percent hedged here, which we can see right here at the bottom, the percent hedged here is 0%. We're going to take this matrix, and the entire next hour is going to be focused on how do we understand the decisions, how do we understand the strategies, whether it's crop insurance, whether it's a marketing decision, whether it's making a basis or cash decision, selling some futures, buying some puts, selling some calls. How does that actually fit into this? Relating crop insurance back to our understanding of our farm's risk is critical. Here, we're looking at, again, this is exactly the same as it was before, still at 0%. But now, with an 85 RP policy, and this is looking at a 570 spring price. We don't know what the spring price is going to be yet, obviously. With a 570 spring price, we've paid some money away, but we've also bought ourselves profitability in every single sell, right? Understanding what our crop insurance is doing for us is critical to making the right decisions around risk management holistically, and really kind of the first step for us. When we're thinking about the tools that we have, most producers, when we're thinking about risk management, primarily just think about cash sales, right? How much do I have sold? What is my percentage sold? I've sold 10%, I've sold 20%, I've got 20% in a min-max contract or a pro pricing type of contract. This is how much I have sold, right? But what the analogy that I like to use back to producers is that cash contract is like a hammer, right? And if the only drawer that we go to in our toolbox is the hammer drawer, we're just going to be solving hammer-type problems, right? There's a whole bunch more drawers in here, though, right? Number one is insurance. Insurance is the backbone of all risk management. Why? We get to buy it wholesale. Uncle Sam wants to pay for up to half of what we're doing, and in some cases more than half. We need to be taking advantage of that. But more than that, there's a whole bunch more instruments, financial instruments that we can use to manage our risk, whether it's a put or a call or a future. An OTC contract, so you might know it as an accumulator or a min-max contract. All of these things allow us to change our risk in ways that a simple cash contract does not allow us to do on its own. And finally, we want to think about separating the decisions of futures and basis. Does everybody in here use futures and basis contracts separately, right? Do an HTA or do a basis contract separately? Well, what we're looking at here is we're looking at two different graphs. On one side, we're taking a look at the change over 30 years for a futures contract. So this is a range. This is the range of prices on a percentage basis moving higher, right? And we can see that there's significant movement here in terms of where it can go, right? The black, this is the average. This is our median price, right? And one of the things that we see is that prices hold up pretty well. Prices hold up pretty well through the springtime, but have a pretty significant drop-off on average from June into the end of the summer. This past year, we saw really significant run-ups here during the summer, dropping down significantly and then rising again, okay? On the other side, we're seeing basis. Here is basis. We have basis on average improving about a dime. This is across the country, improving about a dime, but it can increase on average about 20 cents. So what we're seeing is at the time that futures prices are declining, basis prices are going up. So where one is working for us, the other is working against us. We must keep keep in front of us exactly where the differences are here. What is the right decision to be made? Sometimes that right decision is to set them both at the same time. Cash, setting that HTA, setting that basis at the same time, and wrapping it up. But on average, what we actually see is that separating those decisions, trying to price the futures when they're at the top, trying to price the basis when it is at the most advantageous time, is the right thing to do.
Just to clarify here, I just want to point out that the basis chart is a new crop basis. And so it is logical when there's uncertainty about production, grain buyers are going to probably discount their bid, discount their basis further in advance for a new crop contract. And as you get closer, that new crop kind of forward basis starts to appreciate on average across the U.S. So I just wanted to point out that is a new crop basis. That is not, other forward months, specifically Octave-D's December delivery period.
Absolutely. And with that, guys, do we have any questions? If anybody has any questions, just raise your hand, and Frank will come to you with a mic.
Test. Is the matrix that you showed up there, is that a tool that you have available on your website or app?
Absolutely, that's a great question. So that matrix is definitely available on the app. It is a tool called Scenarios on the app, but we actually have a more powerful version that our advisors use on the backside that allows us to do some more sophisticated sandboxing, as well as see a little bit more metrics to give you more insight. Great question. And again, the entire next hour is going to be talking about how those matrices can demonstrate a variety of different strategies. Anybody in the back? Somebody's got to have a question about some interest rates. Right here. I'm sorry, maybe he was just eating peanuts.
What are interest rates going to do?
Thanks, Frank. So we talked about interest rates a little bit. As everybody knows, Prime's sitting at 7% right now. Most of your operating lines are tied to Prime. The anticipation is that's going to go up another 0.5 point here next week. So fully anticipate your operating lines are going to move up another 0.5 point. The anticipations are from the Fed, what they're seeing is there's going to be another increase the next time they meet after the first of the year. So fully anticipate there's going to be another 0.5 point to 1 point in increase over the next couple months, which is going to directly affect your cost of capital and your cost of borrowing with your operation. Costs aren't getting any cheaper, so that will start to have a major impact on your borrowing and your operation, your cash flow. On the long-term interest rates, we're starting to see the Fed is talking about tapering a little bit. We just put out a report on that with Kevin McClure and our team about the outlook on that. So hopefully there's some easing that's going to go on. Long-term rates have started to back off just a little bit, which will hopefully have a positive impact on people on the land side as well.
One point that I just wanted to make is that, in years like this where interest rates are increasing and, it is more expensive to utilize, funds for risk management, this is a good time to make sure that you talk to your crop insurance agent and evaluate all of the options, specifically because the premiums that you're going to be paying are due after the crop is sold. And being able, if you can, compare those to other potential scenarios using futures or options or in the cash market, you can kind of start to weigh out the trade-offs. And in years where interest rates are increasing, that may give you the protection that you want without necessarily exposing you to a strategy that may require additional capital.
I've got a question for the group. Who thinks of your crop insurance as part of your marketing? Can I get a show of hands? So that's about half of us. Sounds like we've got some work to do on the other half.
So what would can you hear me?
Yeah.
Okay. What would your advice be to a young farmer getting into the business in the next coming years?
It's a great question. Who'd like to take that?
So, I mean, I think there's a lot of advice out there. I mean, obviously, everybody has their own opinion. I'm probably considered on the younger end of the farmers as well in our operation. The biggest thing about farming that I think all of us here are obviously trying to engage in and trying to learn is it's a business. Manages is one, especially when you're a young farmer. Come prepared, whether you're working with a lender, working with FSA, get your ducks in a row, figure out your business plan, work effectively and proactively on that, document everything you can, and start to lay that plan out in front of them. Show them how it's going to come to fruition, how you're going to get there, what you're going to do to get there. And I think that's imperative. And communication, no matter which line of business you're working with, communication is always the key, especially for a younger producer trying to produce or prove themselves. So I think those are the key imperatives there. It's never easy, but making sure you're documenting how you're doing it and being proactive and putting it in a plan is going to be critical for you.
That communication component, I think, is one of the benefits of thinking about risk in that matrix of outcomes, because you can describe where you're most vulnerable. And then you can describe what you're doing to defend against those vulnerabilities. It allows you to take a picture and share it with anyone that's also farming with you or is a stakeholder in your operation, and it can help you stay on the same page as everyone else that is working alongside you. If you're the only one that's primarily handling the marketing decisions, that can be a really big burden. Making sure you have that communication with the maybe partners that you have in that farming operation that are also exposed to these price risks is a benefit to speaking in that matrix of potential outcomes, because they can understand what you're doing, they can understand the risks as it's laid out nicely in a series.
I would encourage you to make sure that you've got a really knowledgeable expert crop insurance agent. There are a lot of opportunities and strategies that you can employ depending on the situation. As a beginning farmer, there's beginning farmer and rancher options for crop insurance to provide some benefits for people starting out. Same thing with the FSA office. So make sure that you're knowledgeable of that. And as far as the strategies, that's where the specialist comes in for crop insurance, because it takes a lot of questioning, a lot of thought, sometimes some planning. Sometimes it's if you got an opportunity where land is going to come over potentially over the next couple years, 5 years, 10 years. There's some long-range planning you can start to do even in crop insurance.
I think the one thing I didn't touch on, and this goes for everybody, not necessarily beginning farmers, Cody had a slide in there, build an advisor team. I think that's key critical for everybody in farming, whether it comes from the risk management side, the financial side as a whole. You can't all be experts at everything. I know from personally speaking, we're involved in an operation. My family that I'm involved with wants nothing to do with the financial aspects and the marketing aspects. So we have to have experts that can do that focus their attention on that. Everybody can't be an expert in accounting or HR or labor management or anything like that. So build that team around you. Make sure you have trusted advisors and resources that you can reach out to and bounce ideas off of. It's going to be key critical for everybody. So.
We've got time for one more question. Right here.
You mentioned long-term interest rates tapering and short-term interest rates going up. Yep. Do you have any strategies, or is it a good idea to move short-term money to long-term money?
That's a tricky question. So We have started to see the yield curve invert. You are starting to see that right now, which makes some of those decisions a little bit more difficult. What we are seeing producers take advantage of right now is something in that midterm, maybe a longer term amortization on a 3 to 5 year adjustable rate, and looking to take advantage of an interest rate modification in the near future. So we've started to see the long-term interest rates back off quarter to 35 basis points, but those short-term rates will continue to move up if the Fed continues to make their adjustments. So you'll see more inversion probably over the next couple months if it continues at the pace and what they're expecting. So if they're doing that, long-term interest rates make more sense than a short-term interest rate at that time. Long-term rates still aren't as good as they were 2 years ago, and it's still a tough pill to swallow, but it's still something you can put in place. And as long as you put yourself in a position with no prepayment penalties on a loan, you can make those adjustments if rates start to dip. So.
If we have time for a quick question, got about 2 minutes left. Any last questions? Right here. Frank?
If you had somebody call you for the first time and pitch the best scenario to that farmer, say, somebody's up and coming on the farm, what would you suggest to them? And, sort of like if you farmed, and what would you actually do? Regardless, I know prices vary and everything, but.
Well, so the question there was, what would we actually advise a young farmer to do? Right. Well, it really comes back to everything that was just talked about here in terms of making sure that you know where you're at. Right. Having it all quantified allows you to explain your business plan in ways that writing it down on the back of an envelope or on a napkin just does not move the ball forward with a banker. Mm-hmm. Having it all worked out in terms of the plan that you're going to be implementing, and we all know that plans are only good until you get hit in the face the first time, mm-hmm. right? Then we've got to come up with something new. But having a plan gets you started. That's really kind of the crux of it. Typically, as a new guy, you don't have a bunch of money, right? If you're at the end, you typically have more money. If you're at the beginning, you typically don't have a lot of money. You've got to figure out how to execute the strategies. No matter what they are, you've got to figure out how to execute the strategies with less money, likely, than somebody that's flush, somebody that's towards the end of their career.
Yep. And I'd say, probably another tilt on your question is if you're just somebody new to FBN, like you call one of our advisors and you're like, hey, what should I do? I think the first step for any of us, any of these divisions, is we got to learn your operation. What makes sense for you? Everybody's different in here. Everybody's operation's different. It's case by case scenario. So every one of us really just needs to learn what works for your operation, understand how you operate, what you need, and then we can start building a plan, whether that's financing, insurance, or advisory. We're going to build that off of your operation individually, and it's got to be singled out that way. So.
I think that's about time here, guys. You guys have been a great crowd. We're going to be doing this again here in about 10 minutes. We're going to really be digging into some strategies, crop insurance, futures and options strategies, and making all of those kind of work together. So come back here. We'll be here 2 o'clock. Thanks, everybody.
Thank you.